This Friday sees the latest US jobs report coming at an opportune moment for financial markets as we see a sea of red for equity markets. That, of course, is centered around the imposition of tariffs from the US on Canada, Mexico, and China, with a view to potentially doing more against the likes of the EU down the line. But nonetheless, there's also a story around what those tariffs are going to do to the US economy, what the Doge group are doing in terms of pushing job losses with a view to cutting down government spending, what that's going to say about the economy, and whether we're heading into a phase of stagflation. So this jobs report is going to be a particularly big one for financial markets. So here are the expectations according to Trading Economics. As we can see here, the expectation is 150k for the non-farm payrolls figure, up from 143 last time around. Unemployment to remain at 4% once again. Average hourly earnings down to 0.3. Year-on-year metric 4.1. Participation rate 62.6. All of these are pretty much exactly the same as the prior month, right? So the average hourly earnings figure coming in on a month-on-month basis lower. That is one significant change. Non-farm payrolls expected to come in higher. That is a change, but of course that comes off the back of a relatively weak figure last time around. A decline, notably in terms of government payrolls. That's going to be a central focus for us. And then those non-farm payrolls private, also another area of focus for the markets. This comes, of course, at a time where we're seeing huge concerns around a number of different factors, right? And it's difficult to wrap it all into one. But one area is concerns around the economy. And the concerns around the economy are centered around, to some extent, the fact that they are looking to cut back massively on government spending. We'll get into it a little bit better later on in this presentation. But essentially, government spending has been propping up the jobs market. So the fact that they're cutting back heavily on that does point towards the possibility of weakness from that perspective in terms of the job numbers. Now, given the fact that we've seen the weakness in terms of the economic outlook from the likes of the Atlanta Fed with the collapse of the GDP now, GDP estimate, the idea that we're going to see weak jobs data plays into the recent narrative that is a weaker US economy going forward. At the same time, of course, we're seeing migrants being moved out of the country, sort of illegal immigrants or those with criminal records that they want to get rid of. And that removes people from the jobs market. To some extent, that might go down as people losing their jobs, but then to some extent, it creates new openings. And new openings could mean new job creation. So there's a sort of wide dynamic playing out when it comes to the jobs market. But certainly jobs are going to be relatively central at this current time when it comes to the economic data. Now, a few things worth looking out for. First and foremost, this is the outlook for where things lay at the moment. Remember, unemployment expected to remain flat. We didn't see that sort of bottoming out and picking up. So unemployment at the moment, not necessarily providing us with warning signs. 143 for the previous non-farm payrolls figure. Well, expectation we tick up to 150. Again, not necessarily anything too outstanding. We've seen a normalization in terms of payrolls and expected to remain around there. Average hourly earnings expected to remain relatively steady. It appears to be the case that that's bottomed out at the moment around 4.2%. So nothing too crazy there. Now, this is part of the story around the US economic weakness that people are fearing right now under Donald Trump. And so we are seeing, coming into Donald Trump's tenure, we're seeing weakness in terms of the economic data in the US. The Citigroup Economic Surprise Index essentially measures data in the US and says, is it coming out better than expected or worse than expected? And we can very clearly see here it's coming in worse than expected. And that's driving the 10-year yield lower. That's driving the 2-year yield lower. Why is that? Because people are expecting to see a weaker US economy. And in particular with the 2-year yield, if you see a weaker US economy, then you have greater expectations of easing from the Federal Reserve as they need to step in to prop up a ailing economy. Will that come to fruition? We don't necessarily know. But of course, at the moment, markets are just trying to price what could happen in the future on the basis of what's happening right now. The ISM PMI report that we've seen this week on Monday provided us with a nod to the stagflation story that's emanating throughout markets right now. First and foremost, inflation. You can see that with the red line, and that is prices paid. We're seeing a sharp rise in terms of the prices paid element within manufacturing. To some extent, it appears to be people are front running the tariffs. So if they're doing that ahead of the tariffs, what's going to be the state of play once tariffs are imposed? We're likely to see prices rise in the US. And there's a raft of goods that the US is reliant on when it comes to, in particular, its neighbors, Canada and Mexico. They have huge trade between those three nations, and it's hugely beneficial to those nations. If the US suddenly sees all of the products from those countries rising by 25%, people have the choice to either buy US goods, which maybe that's good for US companies, or just continue to buy it, and they see 25% higher prices on many of the goods that they purchase. Well, they're probably going to do a little bit of one and a little bit of the other, which means that by and large, we will see higher inflation over in the US from that perspective when it comes to goods. Whether they find an agreement on this, that's a different matter. Then on the flip side of it, you can see the weakness that is the other side of the stagflation story, which is the lack of growth. So what have we seen here? We've seen new orders collapse into contraction territory. We've seen employment dropping down into contraction territory. And we've got production moving lower and closer to that 50 threshold. So a slowdown in production. So all of it points towards stagflation coming into the fore in the US economy right now. That's why we're seeing weakness in terms of equity markets. Inflation is a big concern. Of course, like I said, tariffs point towards the possibility that US consumers are going to be paying higher prices. US businesses would have to pay higher prices as well for inputs for their own products. So the idea that if a business is in the US, then it's completely shielded from this, that's not necessarily the case, because they might have to import a good to be able to then implement it in their own product. So the idea of saying, move your operations to the US and you won't have to pay tariffs, that's not strictly true. And also, you might have to get tariffs implemented in the opposite way around. If you move your production to the US and then you sell back out of the US, well, countries are reciprocating with their own tariffs. So you might get hit on the way back out of the country. So it's a potential lose-lose situation. Now, this is the 6-month annualized change metric. So this essentially looks at how inflation over the last 6 months has picked up. It strips out some of the sort of more historical data of the 12 months and sort of points towards the average trend that we have been seeing of late. And what we can see here is pretty much everything is moving towards the upside recently. So the direction of travel for inflation, even without tariffs, has been moving towards the upside. So how does this look in a month or two's time if they keep tariffs in place? That's a major fear for economic markets right now. If we're looking in terms of, this is not unemployment, this is the payrolls by industry. So 143, we're expecting to see it move in a little bit higher. By and large, the trend generally is on a downward slope, but we've somewhat normalized here. And so if we sort of tick higher, then we don't necessarily see a major story around weakness. If we did see a sharp move lower, or even a move lower from last month, I think that would just serve to sort of compound that recent disappointment of US economic data and point towards the possibility of further weakness in terms of the US dollar, weakness in terms of equities. And that's because we would expect to see US equities potentially weakening off the back of the possibility of economic weakness in the face of high inflation, which might tie the hands of the Federal Reserve. So, there's this whole thing of bad news is good news and good news is bad news, right? And that does play out sometimes, and sometimes it doesn't. And in this circumstance, there's a chance that what we could see is bad news for equity markets, because bad economic data coming at a time of high inflation or higher inflation means that the Federal Reserve don't do anything in return. And therefore, the equities essentially have to deal with the downside of the poor economics right now and don't necessarily have the benefit of things sort of turning in their favor when it comes to the outlook for interest rates going forward. So that's a key backdrop to this. Now, also bear in mind that we have been talking about the role of government spending within all of this, and the idea that Donald Trump is looking to reshape the US economy. And it's been said that it's going to take 6 to 12 months for this to become a Donald Trump economy. And that Donald Trump economy means we don't want to keep spending money to create jobs. We want the private sector to do that. But that isn't a one-for-one transition from one side to another. That's something that will take time. They're certainly moving quickly with the Doge team essentially just slashing jobs, making people prove that they're actually working. And so the idea that we're seeing massive cutbacks across the US government, that points towards significant job losses. And that's the kind of thing that could force the hand of the markets when they start saying, well, hold up, we're seeing huge job losses in the US. So keep a close eye out on the government spending metric or the government job creation metric. On this chart, it's the pink section at the top. And so it's quite difficult to really gauge exactly how important it has or hasn't been from a historical perspective from this chart. Now, one thing I would say is if you want to track this, look at the trading economics calendar. The trading economics calendar comes out with a raft of data points rather than simply non-farm payrolls. It will also come out with, let's go back to the first slide. Here we go. Government payrolls. 32K last time around, this time expected minus 20K. So we've got a downward pressure coming on payrolls for the near term coming from that government element. Now, like I said, that chart doesn't necessarily highlight exactly the role of the government's spending or government job creation. This does. So I've taken that segment out, the government job creation within the payrolls report, and divided it by the overall job creation minus that government, right? So we want to see government job creation versus the rest as a ratio. And what have we seen? Well, generally, this only moves higher during periods of crisis. And this reminds me of the 2008 crisis, because what I remember, and at the time I was a mere young buck in my early 20s and looking for jobs straight out of uni, there weren't many around. But I tell you who was hiring. It was the NHS and the government. And so that's what often happens, right? The government spending and job creation rises at times when the private sector can't handle it, right? So they try to spend more to reinflate the economy. And so you can see that here, right? We see 2008, a massive ramp up in terms of government hiring as a proportion of overall hiring, and then it falls back for years to come. Then it happens once again in 2020 with the COVID pandemic, right? And then it falls back heavily. But what we've been seeing under Joe Biden is that it's been rising over recent years. That's not necessarily normal. And what it does point towards is the strength we've seen in terms of the jobs market being underpinned by spending within the government and hiring within the government. You can criticize that and say that shouldn't be the case and Donald Trump's doing the right thing. But you've also got to be aware of the fact that that downward pressure in terms of that element, the government spending and government hiring element, is likely to put downward pressure on jobs and job sort of payrolls numbers as a whole. And so maybe it takes a bit of time. And this idea that, 6 to 12 months down the line, you're going to see a Donald Trump economy. Okay, great. Does that mean we're going to see 6 to 12 months of awful economic data? Potentially, but there's certainly some bumps in the road. And right now, markets do not feel great about it because they are aware of the idea that we could see a weak economy. All of a sudden, earnings start to turn lower, spending starts to turn lower. All of these different elements that impact the companies and the valuations of companies, they might weaken. But if we see higher inflation down to tariffs, the Federal Reserve aren't going to be able to do anything about it. And so this is going to be a key thing. Keep a close eye out on that government payrolls element. Inflation, like I've said a number of times, is a key concern right now. And so the average hourly earnings metric is going to be your key to the sort of inflation element of this report. What have we seen recently? We've seen an uptick last time around in terms of the monthly wage growth figure. So that has helped sort of lift that 3-month annual that we see at the bottom. The gray band is where we were pre-pandemic. So that's the relative norm. We're above that at the moment. So you can see here in terms of the average hourly earnings on a year-on-year basis, it's at 4.06%. The core CPI, 3.4. So at the moment, it's sort of flatlining. They'd probably like to see that coming down in a meaningful manner. Whether that's going to come to fruition or not remains to be seen. At the moment, there's a perception that the year-on-year metric is going to remain flat. but that we'll see a normalization and a decline down to 0.3% on that monthly figure. But that really is a reflection of the fact that last month's 0.5 figure is out of the norm. I say out of the norm, it happens once every 6 months. It's not something you see every month. So if we do see it drop down to 0.3, then that's a good thing, because it's sort of averting the fears around a resurgence in terms of inflation. But if we do see it coming in relatively hot, then that raises fears around the resurgence of inflation, the inability of the Fed to be able to do anything if we do see the economy turn. That could be bad for equity markets. This is an outlook of unemployment, which I've inverted. That's the purple line, set against a couple other metrics coming from the JOLTS report. So you've got the job openings figure, and that's been declining for years now. And that sort of correlation with those and unemployment sort of seem to have broken, essentially. But you have got these underlying metrics that are going against the US jobs market over recent years. So quits divided by layoffs / discharges, and then job openings, all of it sort of pointing towards an underlying weakness within the US jobs market. Doesn't mean all too much at the moment, considering the fact that we've got the unemployment rate largely flatlining. So if we saw a shift in terms of unemployment and a sharp rise, then that would be a good thing. But certainly, we haven't necessarily seen anything of that at the moment. Bearing in mind the kind of job losses you could see within the government sector, that's the kind of thing that, with the whole Doge thing, that could start to rear its head. And if we see a sharp rise in terms of unemployment over the coming months, that's something that could really provide a warning sign for markets that they would have to react to. So another factor to be watching out for. What have we seen recently in terms of market expectations around the Federal Reserve? Well, yes, inflation expectations have surged. We saw that with the Michigan 5-year outlook, rising to the highest level since 1995. That was a couple of weeks ago, I believe. And so that came, but markets at that time were really digesting the weakness seen within the services PMI. And instead, people were worried more about the recession fears than the inflation fears, right? So that's why people just started to factor in a greater degree of rate cuts from the Federal Reserve, because they thought, well, the Fed's going to have to do something if the economy turns south. And that's why, you've got these different factors. You've got the jobs and the jobs element, whether it's unemployment or payrolls. And if they come higher or lower, that's going to be feeding into expectations around the direction of travel for the economy. So that's the sort of the stagnant part of stagflation. And then the inflation part of it is coming down to the wage growth numbers. So you've got all of it within one report, albeit they're not the direct numbers. They're not GDP and CPI. Instead, they're NFP, unemployment, and average hourly earnings. But they all play a role. And certainly at the moment, markets are pricing a greater degree of easing from the Federal Reserve going forward. We've seen an easing of that expectation that we're going to see just 25 basis points and worth of cuts by the end of the year. Instead, we're pushing towards 1, 2, 3, so 75 basis points or 100 basis points. So, these expectations swing massively. And right now they're swinging in favor of more rate cuts. That's why we're seeing such significant downside in terms of US yields, downside in terms of the US dollar. And certainly, at the moment, we're not necessarily seeing equities benefit from that because the equity markets are just fearful around economic weakness in the face of higher inflation and what tariffs might do to businesses. I know that there's this idea that Donald Trump's going to be pro-US businesses. Well, the US stock market doesn't look that way. So people are very fearful around what exactly this might mean when it comes to the outlook for businesses going forward. So let's get into the outlook in terms of markets as a whole. First and foremost, I wanted to take a look at, let's just get it up here. Excuse me. Well, there we go. Excuse me. Sorry about this. I need to grab this. There we go. So there you go. This is cable. Cable's an interesting one because we're talking about increased degree of easing when it comes to the Federal Reserve. I don't necessarily think we're going to see the same amount of easing when when it comes to the Bank of England at the moment. There's still some fears around inflation coming into play there, but the economy not necessarily in the same position, quite frankly. And what we're looking at here is a sort of resurgence playing out here with the weakening of the US dollar. Now, certainly the US dollar as a whole has been losing traction. And given the fact that we're sort of coming off this area of prior support, I think there is a good chance that we come in for further upside to come over the near-term period as we see that US dollar weaken. Now, ultimately, and this is often the case, these FX markets are driven by one thing or the other. And one thing is the US dollar strengthening, and the other is US dollar weakening, right? And you can say, ultimately the cable could go up and euro dollar could go down. But by and large, if cable goes up, euro dollar will go up, and dollar CAD will probably go down, and dollar yen will probably go down. It's a very dominant currency. And so, by and large, what we're talking about cable, we could be talking about euro dollar. Many of these currencies are going to be trading heavily focused on the outlook and the state of play in the US at the moment, with the deterioration in terms of yields over in the US, with the expectation that suddenly we're going to see potentially 100 basis points worth of cuts from the Federal Reserve. All of it plays into weakness for the US dollar. So what are we seeing here? Well, we're seeing a rally into trendline resistance. You could say this is a rising wedge formation, but you could also say that, you can draw it out sort of more like here. I guess that's also a wedge. But you're looking here at this sort of challenge of trendline resistance. So do we see a pullback? Well, even if that does come into fruition, I wouldn't necessarily worry all too much. You'd be looking at a sort of retracement phase to come into play here. Like I said, a lot of it comes down to how the data is coming out. Market expectations don't have a huge amount of interest at the moment. They're pretty average stuff. A lot of it sort of expectations of things to remain relatively flat. But nonetheless, if we see something that really sort of shocks the markets and points towards more economic weakness in the US in particular, a low payrolls figure, a high unemployment figure, that's the kind of thing that's likely to drive this pair higher once again. If we don't necessarily see that, but we see a strong move higher in terms of wage growth, then that's the kind of thing that could potentially strengthen the US dollar, but it's not a given. But ultimately, we've got a bullish trend in play here at the moment. I think there's a good chance that we continue to see the US dollar weaken, not necessarily over just the near term. I just think that we're going to see quite a lot of US dollar weakness over the course of this year, quite frankly. So do we see ourselves as being relatively stretched at the moment? It's difficult to say, but you'd probably be looking at things on the sort of intraday basis and saying, like right here, we're pulling back. We've come into, let's see if we've come into the 76.4. So we've come into a deep retracement, moving sharply higher once again. So it's a case of sort of following that intraday trend at the moment. If we see a breakdown through your prior swing low, which at the moment on an intraday basis is at 1.267, that's when you look for the wider retracement into trendline support. But until that happens, the intraday trend points towards further upside coming into play here for the likes of the US pound against the US dollar. So let's just get the Tech 100, or essentially the Nasdaq, up. So the Nasdaq's been hit hard recently, to say the least, quite frankly. And if you were to say put it into a line chart and put like the SPX in there you go. The Dow Russell 2000 is the only one that's probably hit hardest. So you can see here that recently, let's say over the course of the past couple of weeks, you can see the Russell 2000 has been hit hard. And beyond that, you're looking at the likes of the Nasdaq. So the Nasdaq's been at the forefront of this. And part of it is this idea of US stocks being overvalued. And bear in mind, when we're talking about stagflation in the US, we're not necessarily talking about stagflation in other economies. The idea of a deal between Russia and Ukraine is great news for Europe, in particular Germany. So German economic outlook could improve, although it's been in an awful position for a long time now. And inflation just isn't a problem when it comes to the Eurozone right now. All right. So, for me, stagflation being a US issue, that points towards US markets underperforming. And then you look at these indices and you look at the Russell 2000, that's going to be at the forefront of it because a bad economy is bad for small, non-profitable companies, and high borrowing costs because of inflation being a sort of tie in the hands of the Federal Reserve. That's bad for businesses that continue to borrow. Behind that, we've got the Nasdaq, where people are thinking, hold up, if there's a company that's overvalued, it's probably this huge tech company here with massive multiples attached to it, and fears around the sort of deep seek and the fact that China might be getting in on the action sort of undermines some of that story anyway. So anyway, all in all, it's to sort of point to the fact that, in the state of play at the moment, 4.3% downside here for the likes of the S&P 500, but the Nasdaq down the likes of 6-7% over that same period, 2 to 3 weeks. So let's look at the Nasdaq. This is sort of the background to why I wanted to look at this index in particular. Let's look at it from a long-term perspective. So you can see here that the trend, of course, is bullish because this has been a big AI tech-led rally, really. And you can see on the bottom end, we've got this ascending trend line of support. Are we there yet? No, we're not. Might this play in and provide support? Yes, potentially. And certainly if we're looking at a potential correction, where's the correction in all this? Well, we're not there quite yet. The correction is 10%. So where's your 10% marker? Roughly there, right? So you can say that the low that we've hit is near enough a correction. So, do we see further sort of chop and we sort of remain around this correction territory? I personally think a lot of people have investment strategies based on the idea of buying some of these major indices at correction levels. So the idea of the bulls coming back into play, there is a potential for that. Now, look out for this as a retracement of the wider move. Remember, we've broken through this key support level. So where's the support now? Well, of course, we've got that trendline support and we've got the prospect of Fibonacci support. Let's see exactly where that is. So we've got deep fib zones look like they're well beyond that trend line. Beyond that, you've got the 50% retracement. So if we're coming for further downside, look out for this area with the 50% and the ascending trend line in particular. But ultimately, yes, we're in a sort of bearish mode at the moment. But, you could say the same kind of thing back here. And we do have periods where the market flashes lower. Everyone thinks it's the beginning of a huge crisis. And soon enough, something is averted. And ultimately, if you're looking at what might sort of push Donald Trump in a different direction, well, maybe it's the stock market. He's seemingly not listening much to many of the other leaders. But if you see a deal between Russia and Ukraine and all of a sudden, Zelensky's moves to try and sort of bridge the gap seem to work, then maybe markets are a little bit calmer. If you see a trade deal between some of the countries that at the moment it looks like they're just going to impose tariffs on each other, if you see a trade deal instead, then that's the kind of thing that could see markets bounce back once again. But at the moment, everyone's wondering whether to buy the dip. And I'm not necessarily saying buy the dip right now, but I don't necessarily just think that I'm going to look at a chart like that and only trade it in isolation, right? This is a very relevant chart, and you can point towards it as a grounds for further downside to come, right? So, if we rally here, then yeah, there's a good chance that we could be just rallying and retracing part of that before we roll over once again. And so a breakthrough 21070 would be the key requirement for the sort of bullish outlook to come back into play near term. But certainly it's worthwhile always zooming out and looking at the big picture. And the big picture remains bullish for this market. Look out for where these key support levels come into play for the Nasdaq. Are they respected? Is trendline support respected? Do we then break out from that structure in an intraday chart and start to turn into higher highs and the like? These are the kind of things that can provide the bullish opportunity. But right now we're selling off. So the bears are very much in charge. The risks still remain very heavily within the markets. Markets are very fearful right now. That doesn't necessarily mean that they can't bounce. And the difficulty under Donald Trump, I've found, certainly having done this job over the course of his previous tenure, I've found that the difficulty is that just when you think one thing's happening, he'll flip it on the head and come up with an announcement and say that the complete opposite is happening. And like we've struck a deal, one day it's going to be the end of the global trade because he's enacting huge tariffs, and then a day later we found this deal and they're going to buy a huge amount of our products, and all of a sudden think, okay, this could be good news for both economies, blah blah blah. So volatility, there's going to be plenty of that, but at the moment the bears are in charge. But look out for that ascending trend line coming into play. But like I said, the jobs report going to be absolutely massive, in part because of the fact that it has elements of both the stag and the inflation that are really spooking markets at the moment. I hope that's been useful. It's a bit of a long one, half an hour, but it's an interesting topic and an interesting week. Good luck with the trading. Make sure that you are always sort of following a sensible approach when it comes to risk management and the like. And I'll see you on the next one.